transactional. Now, so what we've got set up is an asset and a liability. We then have to subsequently measure the asset, have to subsequently measure the liability, and the way that we do that is by using what is effectively the effective interest method from last week. So when we draw up the table of the liability and work it down, look at how much interest expense was, look at the effect on the principal, go down to the next line and work it all through. That is exactly what's happening here. The other thing that we then have is an asset. And this gets treated just like any other property, plant, and equipment. We have depreciation, just like normal. We'll have impairments just like normal. I don't think you can, I'd have to double check that. I'm pretty sure you can't revalue. But you have depreciation and you have impairments. The only issue with depreciation is if I've leased this car off Harris for 3 years and I'm doing it as a finance lease, but the car's useful life is 10 years, do I use 3 years or do I use 10? And the way paragraph 27 talks about it is you depreciate it fully over the short, or if you're not going to get ownership, you depreciate it over the shorter of the two. And again, it makes a lot of sense because if I'm going to give it back, you're just depreciating it over the time you're going to use it. If I'm going to keep it, you depreciate it over the longer term because that's how long you're going to use it for. So if he's given me a bargain purchase option of $20,000 to buy that car, we're going to depreciate it over 10 years because I am going to buy the car and I am going to use it for 10 years. And on that note, we're going to have a look at the first demonstration question because it is a good time to do that. And with this demonstration question, there's actually not, there's probably little tricks we can put in there, but there's not a huge amount more that we could do with this. It is fairly comprehensive. If I can find it. Online, presentation. There we go. So, what we have here is the information to start with. It's probably a good idea as you're going through this just to pull out the information that you need so it's easy to work with. So what we have, I'll just make that a bit bigger. So what we have is an aircraft is being leased and the term is 5 years. Or if you want to call it 5 periods, whatever you need to do, but 5 years. The fair value of the aircraft upon inception was 100 million. The lease payments are a really funny looking number, which has been done for a reason. Bless you. And they've been done in arrears and they're annual, so they're the same length of the period. There's a guaranteed residual of 50. The rate implicit is 7.5%, which makes it kind of tricky to do with the appendices in your textbook, but nonetheless. Useful life. 5 years, 20 years, it's obviously not for a major part of the useful life, but we're still going to call it a finance lease. And the residual is, at the end of 20 years, is 0. Even though we didn't put it in there, we're going to assume the depreciation method is straight line. And we're going to assume that, and it is expected that they are going to keep it. So all I've done is nothing other than just restate the information in there. And look, in exam situations, it's probably a good idea to do that so you've got something to work with and it's easier to sort of manipulate around. So provide the journal entries for the start of the lease, at the end of the first year, and then the very final entry. So the first step is, as I said before, and if you go back a couple of slides, The first thing that we know we have, because it is a finance lease, is we debit asset, credit liability. The issue is how much. And so the how much is comparing the fair value and the minimum lease payments. Now, from that, and because we set this up this way, and this is probably an area where it could be different, we've set this up so that they actually work out to be exactly the same. So normally you try to be picking the lower of those two numbers. What we have is a series of cash flows. 1, 2, 3, 4, 5, 16.1, 16.1, blah, blah, and 16.1 plus 50 at the very final one. So it's just a set of cash flows discounted at 7.5%. That will give you a present value. So we are, as you're probably starting to get the idea, we are seeing a lot of present value calculations in what we're doing in the second half of this subject. So they're obviously not difficult to do, but you need to be aware that you will more than likely be required to do one in an exam. We discount all of them and it will give you $100 million. So we just put in $100 million and that's easy. What we then do is set this up. And this is really similar to what we saw last week. So just with a straight financing instrument, we set up the opening amount comes down here. So we're dealing with the liability at this point. So that opening balance comes down. We know the payments are the $16.1 million, so we just throw that in. The next line is the interest expense, and this is based on the 7.5% rate implicit in the lease. And as I said, that will be provided times by the opening. So whatever the opening balance is, 7.5% of that will give you that particular figure. This is a difference. Because we paid $16 million, but the interest expense was only 7.5, we've obviously paid more than just covering our interest costs, and the rest of that goes to drop down the liability component. So we're slowly chipping away at that total liability. We come to the end of the row, that just comes down to here. Do it all again, that comes down, do it all again, comes down, keep going until we end up with a closing amount of $50 million. And that is the same as that final $50 million payment that we have to make. Now, the alternate way you could do that is instead of putting $16 million here, you could put 66. And you're just going to end up with 0 at that point. So whichever way you want to do it is easy by us, but you are going to end up with either the 0 balance if you put that final payment in here, or the $50 million payment if you just do the regular payments. So you know, just like last week, you absolutely know if you've done this correct, because you're going to end up at a certain point. Now, I'm just going to read out the definition of the liability. I know it's a bit long-winded, just to show how that links to what we've just done here. The minimum lease payments shall be apportioned between the finance charge, which is that $7.5 million, and the reduction of the outstanding liability, which is that $8.6 million. So the first part of the definition is here, the second part is here. The finance charge shall be allocated to each period during the lease term so as to produce a constant periodic rate of interest on the remaining balance of the liability. That's talking about the rate implicit. We don't really need to worry about the calculation of that. Just, we've done this properly, and that's the number that we've given you. So throw those all in, and what we see down here is debit lease liability, the 8.6. So this comes from this column. Debit lease expense, this comes from this column. And credit cash, that comes from that column. And you just simply repeat that for however many years the lease is running. So just before we move on, is anyone got questions on that, or is that relatively comfortable? Well, by that resounding silence, we shall keep rolling. Now, we have the asset to deal with as well. So we've dealt with the liability. We can tick that off. We've got the asset. Now with the asset, come down to here. We have a $100 million asset. We're going to keep it, or the expectation is that we're going to keep it. So the depreciable amount is the cost minus whatever that residual is, divided by the 20 years. And that gives you 5. So that's just a normal standard lease like depreciation expense, amortization expense. 5 million, 5 million. This, unless you have changes in the estimates, which we're not going to deal with, this is just going to be constant through each of the 20 years that you're going to be running it. And then the very final entry, if we haven't put this final payment in here, is just the $50 million. Clear out the liability. I give cash, I'm the lessee, I give cash to whoever I've got it from, and we've cleared out the debt. And that is, I mean, we could throw initial direct costs in there. We could, what else could we do? Not too much, really. I mean, we could make the fair value and the present value of the minimum lease payments different, and that's probably about it. Like, that's a pretty comprehensive question that we've got there. I mean, obviously you've got to be aware of unguaranteed residual and bargain purchase options, but there's not a whole lot more we can do with that. So that's, if you can get that, that should stand you in relatively good stead for where we're going. And on that note, we'll take a break. We'll come back and look at the economic effects, not just on the asset and liability, so the balance sheet side of things, but we're going to construct the profit and loss impacts of why companies prefer to use operating leases rather than finance leases to categorize what they've done. We're going to do that. We're going to have a look at the lessor side of things, and we're going to have a look at sales and leasebacks. If anyone's got any questions, feel free to come and have a chat.